Hello everyone, today we are going to cover stock options and we are going to cover a little bit about golden parachutes and platinum parachutes. So let's start with a little comp in the news. So today Disney announced that it's going to stop paying 100,000 workers globally. It's almost half of its global workforce. But these are tough decisions in tough times. It's going to save the company $500 million in salary. And these staff are going to still receive full health care. So remember, at least in the United States, that's really good so they can avoid that Affordable Care Act employer mandate penalty. And those who are in the U.S. are encouraged to sign up for the unemployment benefits. Those in Paris are going to get onto France's partial activity scheme, which covers up to 84% of their salary. On the business side of things, Disney still expects to pay a dividend to its shareholders of $1.5 billion. And so far, the executive bonus schemes have been protected, although some of their senior executives are taking a pay cut, everybody from VP, SVP, EVP up. Bob Iger, who was the former CEO, is now the executive chairman, is going to forego his salary altogether in 2019. But keep in mind that in 2019, he earned $47.5 million. The year before that, he earned $65.6 million. So he could probably forego $1 million or $2 million. Bob Chapek, who is the new CEO, said that he would take a 50% pay cut. Now, his base salary is $2.5 million, and he's eligible for incentive-based compensation. So you've got the $7.5 million annual target-based bonus. So that's going to be your performance-based bonus, right? And then annual equity-based long-term incentive grant of $15 million. And it wasn't totally clear. This came out at the end of March, and it wasn't immediately clear which part of his compensation was going to take that 50% reduction. But let's talk about that last piece. Talk about equity agreements. And company stock is considered to be the foundation of this equity agreement. Now, a piece of stock, one company stock represents equity in the company, right? And each share represents an equal value. So all the shares are equal, and they can have, many shares of stock, and that's what gets exchanged on the New York Stock Exchange and other stock exchanges. So let's discuss the terminology. So if you go to what in my book is page 270 and table 11-1, and it tells you what all these terms mean. So a stock option, okay, the option to purchase stock just says here we are at a point in time, and right now the company is going to allow at this date, this is where the price of the stock is set, and the company says in the future you may purchase stock at the price that it was, the fair market value price that the stock was today, okay? And then it's going to be designated at some point in the future. So could be a couple of years, could be 10 years. The stock grant is that date of when the company actually offers the stock. Exercising of the stock says that that employee takes advantage of the grant and the stock option, and they actually will purchase the stock at that option price, at that fair market value option price. Disposition of it now says, so you bought the stock, you exercise. Disposition is when you sell the stock. And then fair market value is just the average price of the stock in that one day. So now let's talk a little bit more about the different kinds of stock options. So we have an incentive stock option, which you might also hear referred to as a statutory stock option. And that entitles an executive to purchase stock at a predetermined price. So again, at that grant date. And the goal there is to provide that incentive for the executive to work really hard to improve on that stock value so that when they exercise and sell their stock, it's going to be worth a lot more. So this is something that's very favorable to the executive in terms of taxes. So tax treatment for incentive stock options when they exercise the stock. So when they buy that stock, it's generally not taxable. But when they sell the stock, it is taxed at the long-term capital gains tax rate, which tends to be quite a bit lower than their income tax rate. Okay. Now, the non-statutory stock option has a lot fewer constraints on it from the Internal Revenue Service. So it's actually much more common to go with this non-statutory stock option. And again, this is for companies that are probably don't have a lot of cash, right? They're cash strapped, but they want to provide incentive and have loyalty among their employees and bring in the very best talent that they can. So they're going to use this stock option. Now it's different in the way that it gets taxed, and I'll show you an example in a minute. But basically at the exercise date, right? So at that point, it is taxed at the ordinary income tax rate. And then when you sell the stock, that difference between the price on the exercise date and the price when you sell the stock, that's what gets taxed at the capital gains rate. All right. Okay, so now let's talk about restricted stock. Restricted stock is another type of incentive, really. But at that point, like your board of directors is going to purchase stock on your behalf. And there are a lot of restrictions, and those restrictions might be performance-based or a lot of years. So they're trying to say that, again, you don't own, as the executive, you don't own this stock, not until all these conditions or restrictions are met. So at that point, once you have vested, then the stock just turns over to that executive, and it is treated like any other kind of stock. And in fact, they kind of take out a few of those shares to pay your taxes, and then all that stock belongs to the individual. Phantom stock, on the other hand, is phantom. There is no stock involved. So in this case, it is where the board of directors says, again, if you meet certain requirements, we want to reward this executive by taking the difference between that price at day one, and then we're going to look 5 years from now at what that stock price is, and we're going to be paying that difference. All right, so this really is a bonus more than anything else, and it's just based on the stock price, but there's no stock involved. All right, so let's look at an example for these non-statutory stock options. So we're going to have two people here. You got Diana and you got Stephen. Diana and Stephen both work for this, again, we'll go with the startup company. They are granted 50,000 shares at $1 a share. This is year one. So then at year 4, now they're both fully vested. Diana decides she wants to go ahead and exercise her options, meaning she wants to purchase the stock. So she purchases it at that option price, right, which is that 50,000 shares times $1. So this is the $50,000. Now, because it's worth so much more, it's $5 a share, she's got to pay income tax, and she at her normal rate. So for her, it was $90,000. So she's spending total of $140,000 in year 4. Stephen, on the other hand, he's decided that he wants to hold off. He wants to wait and see what happens. Well, then in year 6, this company's doing amazing. So they have an initial public offering that's at $25 a share. And at that point, Diana sells her shares, right? The disposition of her shares. And she has to pay a capital gains tax between this share price of $25 a share and the $5 a share where she exercised her options. So for her, this gross proceed, $25 times her 50,000 shares, is the 1.25 million, minus the 200,000 she paid in capital gains tax and that 140 she paid when she exercised her options. So her net proceeds are 910. So at this point, Stephen decides he's going to actually exercise his options. So the cost of his shares, again, the $1 times the 50,000 shares, and now he too has the gross proceeds of $25 a share times his 50,000 shares, gets you that 1.25 million, but because he exercised these shares at the $25 a share, and he has to do that at that regular income tax rate. So it's $540,000. So again, regular income tax rate is much higher than your capital gains tax rate. So for him, that's a pretty healthy chunk. So his net proceeds are $660,000. All right, so almost everything that we do under this executive compensation umbrella is focused on tax implications. All right, we're going to move on now. So next up, what is a golden parachute? So a golden parachute is a way to protect your executives when they're out of work because of a merger or an acquisition, and you have two CEOs now, and you don't need two CEOs. So one of them is going to lose his or her job, and this is a way to protect them. So why do you have this golden parachute? You do it because obviously it's going to limit the risk of those executives. It also helps you to attract and retain executives, especially if your company has a really strong competition and the odds of a merger or acquisition are good. And the third one is because of that. If it's a good idea, if it makes a lot of strategic sense to have a merger or acquisition, you don't want this executive to fight against it because he or she's going to be out of a job. You want them to support it and to work toward what's in the best interest of the organization. Now, a platinum parachute is when the executive is damaging your organization, and it will be worth it for you basically to pay them off so that they don't hurt the organization anymore. So it could be bad performance, it could be bad publicity. This is just a way to get them out. So you know it happens with football coaches all the time, right? That they're just doing such a poor job, and the university just wants them out. So they're willing to pay them off for a while. Certainly happened with Les Miles. And so that's just what a platinum parachute is. They're doing such a poor job. Get them out. Start afresh. It's worth it to the organization. All right, so we're going to continue on with executive compensation in our next video. Thanks so much. Bye.